let's take a look at different types of financial statements. Financial statements tell a story about your business and allow you to make good business decisions if the information is accurate. That's why it's so important to have a high-level understanding of the accounting process and what goes on behind the scenes to help make sure that the information on your financial statements is accurate. The balance sheet is a summary of a company's financial status and includes assets, liabilities, and equity. It is always at a specific point in time and is basically the accounting equation of assets equal liabilities plus equity. The income statement, or P&L, profit and loss, is a summary of a company's operating performance and includes all revenue and expenses. The income statement, or P&L, covers a period of time, which could be a month, quarter, year, or another time period that makes sense for your business operations. The income statement, or P&L, is the financial statement that most business owners tell me they look at to see what the bottom line or net profit or income is. However, it is important to review all statements to understand what is going on with your business and your cash position. The cash flow statement shows how changes in the balance sheet accounts and business operations can affect cash or cash equivalents. It shows you how cash flows in and out of your business. Now let's take a look at a sample balance sheet. Remember, the balance sheet is at a specific point in time. It has the assets, the liabilities, and the equity of the business. It shows what the business owns as assets, what the business owes as liabilities, and then the difference of that equity or net worth. You can see on the sample balance sheet, assets are broken down into current assets and fixed assets. Liabilities are broken down into current liabilities and long-term liabilities. Current simply refers to anything that you can convert to cash in 12 months or that is coming due in the liability section within 12 months. Also note that the total assets equal the total liabilities and equity. If your balance sheet doesn't balance, something's off. Now let's take a look at a sample income statement. And remember, an income statement covers a period of time. That could be a month, a quarter, a year, or another time frame that makes sense for your business. The income statement shows the business revenue and the business expenses. In the top section, you can see the net sales less that cost of goods sold is equal to the business gross profit. And then you have operating expenses and the net profit at the bottom. Before we take a look at the cash flow statement, let's review the financial operating cycle. It starts with a balance sheet and the conversion of assets into sales on the income statement and that bottom line net profit that we talked about earlier. And then there could be multiple uses of that profit. The business could purchase a new asset, so then it's going back to assets. The business could pay off some type of liability or a business loan, and it goes back to liabilities. Or the owners could say, we'd like to take some payout, and then that comes out of net worth. Again, circling back to the balance sheet. The cash flow statement shows you how money is coming into and going out of your business. It is broken down into 3 categories: cash flow from operations, cash flow from investing, and cash flow from financing. Each of these measures the change in the accounts to show your total cash flows and ending cash balance for a specific period. Information is entered into the accounting system through source documents that could include invoices, sales receipts, timesheets, bills, or other items that document money coming in or money going out. Journal entries are a chronological record of transactions, and ledger entries are a summary of transactions by account. Let's take a look at the flow of an accounting system. Every accounting entry is based on a business transaction, which is usually evidenced by a business document, such as a check, sales receipt, or invoice. A journal is a place to record the transactions of a business. Typical journals used to record The chronological day-to-day transactions are sales and cash receipts journals and a cash disbursement journal. A general journal is used to record special entries at the end of an accounting period. While a journal records transactions as they happen, a ledger groups transactions according to their type based on the accounts they affect. The general ledger functions as a collection of all balance sheet, income, and expense accounts used to keep a business's accounting records. At the end of an accounting period, all journal entries are summarized and transferred to the general ledger accounts. This procedure is called posting. A trial balance is prepared at the end of an accounting period by adding up all of the account balances in your general ledger. The sum of the debit balances should equal the sum of the credit balances. If total debits don't equal total credits, you must track down the errors. Finally, financial statements are prepared from the information in your trial balance. Now let's take a look at how the journal entries transferred to that general ledger actually impact financial statements. We're going to take a look at the balance sheet and your income statement or profit and loss. So when we're looking at the asset accounts, we have the cash as an asset account, we have inventory, and we have accounts receivable that we've used for this scenario. Then we also have equipment that was purchased by the business owner, so I'm going to go ahead and put that in there. And then I'm going to scroll down here to the liabilities and owner's equity section, and on the current liabilities, the business owner did purchase supplies on credit, so that's accounts payable, and then there was a note payable for the equipment purchase. So to get the numbers for this, and remembering that the balance sheet is always at a specific point in time, we're going to go back up and we're going to look at the general ledger cash account. And if we look at this, we see that there's $5,300 in cash that's been put into the business and $950 that's been taken out. So that difference is $4,350. We're going to go back down to the balance sheet and transfer that amount. On the inventory, we'll go back up and take a look at it. And we see $300 in inventory has been purchased. $200 in inventory has gone out, so the difference there is $100. And we'll go back down and put that $100 on the inventory for the balance sheet. And then accounts receivable, go up and take a look at that. For accounts receivable, one transaction, $300. So we're going to go down and we're going to add the $300 to the accounts receivable. We know that the business owner purchased equipment. And that's $2,000 on there, so we're going to carry that down to the balance sheet. $2,000. So the total assets for the business, $6,750. Now remember that assets always equal the liability plus the owner's equity. So we'll put our numbers in here and make sure that we have it balanced. So in the current liabilities, the accounts payable, we have $100. So we're going to transfer that down. And then we also on the notes payable have $2,000. And we want to make sure that we get that in the liabilities section. And then the owner's equity is a total of the $5,000. So we're going to transfer all of those down. So that accounts payable was $100. The notes payable was $2,000. And then the owner investment, so I'm just going to draw a line out here so it makes it easier since the copy's a little closer, was $5,000. The owner did not take a draw based on any of the journal entries that we did, but we are going to have retained earnings that we're carrying over from the income statement. So let's take a look at the income statement so that we can calculate what that net profit or net loss is and then carry that up to the retained earnings. So let's take a look at the revenue and cost of goods sold. So when we look at the revenue, we're looking at product sales, which is this 400 account right here, and there were $600 sold for the particular time period that we're looking at. And the associated cost of goods sold, right next to it, $200. So I'm going to scroll back down and put in the revenue of $600, that associated cost of goods sold of $200, and the gross profit is simply that $600 minus the $200, so you've got $400. Next, we're looking at the operating expenses, and for this particular example, we have rent and we have payroll. So let's go back up, take a look at both of those and bring those down. For the rent expense, the total is $500, and the payroll expense, the total is $250. So let's bring those down. Rent is $500. Payroll is $250. So when you're calculating net profit from operations, this right here, you're looking at that gross profit right here minus the operating expenses. So in calculating that, it actually shows a net loss of $350. For this exercise, we didn't have other income and we didn't have other expenses, so we're just going to carry that net profit from operations down to the bottom line net profit. And again, that's actually a net loss of $350. So we're going to go back up to the balance sheet, and in the retained earnings, we're going to bring that net loss, which is negative $350, over. So in calculating the total equity, we have $4,650. And then looking at the accounts payable and the notes payable, we have $6,750. So the total assets above right here of $6,750 equal the total liabilities and total owner's equity down below.